I'm Charlotte McLeod with investingnews.com, and here today with me is Nick Hodge, publisher at Digest Publishing. Thank you so much for being here. Great to have you.
Charlotte, it's always good to be with you and talk shop. How are you?
I am very well and excited to be catching up with you from our last conversation, which, as we were talking about before we turned the camera on, was about 5 months ago. So toward the end of 2023. And definitely so much has happened when it comes to gold. So I'm thinking we should start with gold today and check in with you there. So the price, of course, has been hitting record highs, although we've seen a pullback more recently. So what main drivers are you looking at right now for gold?
Yeah, time seems to seemingly fly by. 5 months ago, we were talking about gold just starting to hit 2,000. And as you just mentioned there, it's gone on to hit record prices in the 5 months since. But, even as recently as February, it was just putting in a monthly close at 2,000. And then in the past 2 months, March and April, it, sort of jumped up to above 2,200 and 2,300. So that's a good place to start answering your question, is that gold is starting to check technical milestones, right? It's closing months above 2,000. It's closing months above, and quarters now, in fact, at the end of March, above 21 and 2,200. And so it's checking technical boxes that tell broader, more generalist investors that gold is emerging from a bear market, and it starts to, beget or attract capital simply because it's going up, attracting, additional funds and momentum and swing traders, for example. So that's one reason. The other reason is in the headlines a fair amount, and that's the ongoing conflicts in the Ukraine and Israel and Gaza, of course. And then a bit more monetary driver is buying that's been coming as a result of that geopolitical tension. So, in April, we had some retaliation from Iran, for example, launching those drones. Ahead of that is when we saw some really big days of gold buying, when people were wondering where that buying was come from. People who follow such things as, the exchanges and things were saying it wasn't coming through typical routes, like London was more Eastern buying. So I think all these things are sort of known now that there was Middle Eastern buying. There's been increasing Chinese retail buying, for example. So those are the things that are driving gold. What's maybe perhaps more interesting to me is that, gold continues to ascend and hold its bullishness and price despite other things that are going on in the market. I'm talking about continued high rates, continued strength in the dollar. And so all those things that we just mentioned are driving gold, yes, but gold is really telling you in its own way, through its own signal, that it is bullish and it is going to remain bullish. And then I don't know if you wanted to get into the stocks, but the last time you and I talked, I was saying that we were talking about what hasn't worked, and I was saying gold stocks haven't worked. They haven't caught up or shown their leverage to the gold price, and that's starting to change just here over the past 1 to 3 months. You see, GDX and GDXJ starting to hit better technical levels. And then you have, companies starting to report, like Newmont recently, that are showing that these higher gold prices are starting to trickle down to the bottom line. And that, again, attracts investors who are either new to gold or haven't been paying attention to gold and gold stocks.
Yes, I think definitely I want to talk about the gold stocks, and I'll go there in just a moment. I think before we do that, I'll ask you a couple of follow-up questions on what's going on with gold right now. One point that you mentioned, which is pretty interesting, is some of those elements that you would think would be headwinds for gold actually don't really seem to be a headwind right now. So you mentioned the high interest rates. And I know maybe not in our last conversation, but in previous conversations, we had talked about how gold was waiting for the Fed to turn around and take rates lower, and that might be a catalyst. And I've heard that from lots of different people in the past. But has the Fed then become kind of less important for gold at this point?
Yeah, that's good phrasing. The last monthly issue I wrote about the macro markets was about, tuning the Fed out. And, the Fed's sort of been all over the place. In December, they said they were going to cut rates 3 times this year, if you remember. And then the calendar turned to 2024, and Jerome went on 60 Minutes and was saying that we're going to be cautious and, don't expect cuts too soon. Inflation is starting to reinflate. So, yeah, for sure. I think the market in general and gold specifically has begun to tune out the Fed's noise, the Fed's garrulousness, I've called it in recent podcasts and stuff I've done. At the same time, you have growth. So growth is what's changed to get back on track. I was telling you back in October that inflation was going to be higher for longer, that rates likely would be higher for longer. I used that specific term, higher for longer. And now I see that in my inbox every day here in April 2024, heading into May. So that is what's happened, higher for longer. What's different and what's changed and what I got wrong was the recession expectation. So I was talking a lot about recession that never materialized. And we can talk about why, but we don't have to. What happened is there was good GDP growth in the U.S. in Q3 and Q4, up around 3-4%. And then that has slowed down, but it's not gone negative. So you need negative growth for a recession. That hasn't happened. Instead, you've got slowing growth. I think the number was 1.6%, just came out recently for the Q1 2024 for the U.S. And so in that respect, we just talked about inflation higher for longer, rates higher for longer, but slowing growth. I mean, that's the quintessential definition of stagflation, right? Which you're probably starting to see out there more and more. And so that's one of the reasons that gold has been able to defy those higher rates that are typically, push gold lower, or that it has an inverse correlation to. At the same time, other currencies have weakened. So, the yen has been extremely weak against the dollar. And so those are sort of, and the dollar has been strong, but gold has, again, providing its own signal that it's bullish.
Right. And I definitely have been seeing those stagflation headlines start to proliferate, I think, toward the end of last week. So that seems like something to keep an eye on. For the gold price, I think people are wondering how high can it go in 2024. So I wonder if you have thoughts there. I'm also curious, how low could we go? Because we are kind of in this correcting time, at least for the moment.
Yeah, so high, let's do higher first. I mean, you sort of seen how wide the candles can go. I mean, you had days on gold where it was adding, 40, $50 and more in a single day, climbing above, 2,400 at one point before starting to consolidate. So I think 2,450 to 2,500 is a good near-term target for gold, sort of 3 to 6 months. Definitely time to be buying weakness down to around 2,300. So now I think you have sort of supported in the 2,300 area, and I'd be concerned if it dipped below that. If it does break down below 2,300, you asked about downside. And now I think what was previous psychological, resistance at that 2,000 level becomes your support. That's typically how markets work. So support at 2,000, but again, you'd have to break down below 2,300 to bring those lower numbers into play.
Okay. And let's move over and take a look at the gold stocks. So as you mentioned the last time we talked, you had mentioned they were not working relative to the gold price at that time. So now it looks like that is starting to change. So maybe you can go into what you're seeing there, why it's starting to change, and whether that may accelerate and pick up some steam.
Sure. So you had inflationary pressures that were weighing on the producers for the past couple of years. I mean, you had inflation that was at 9% in recent memory. So that was in some of the things that are input costs for miners, diesel and commodity inputs. So first they had that cost inflation that sort of compressed their margins. And so they weren't returning metrics that attract broader investors on a cash flow basis, a PE basis, et cetera. In the past 2 years, as gold has gone above 2,000 and now at record prices that we've talked about, you're starting to see the attractiveness of mining reflected in the earnings and the balance sheet of these companies that are reporting. Most recently, Newmont, who is showing an increase in cash flows. Their costs, they're all in sustaining costs are still up there around 1,400 or even a bit higher than 1,400. But that's different when gold is trading at 23 and 2,400. It allows more of those profits to fall to the bottom line. At the same time, inflation does remain sticky high, but it's come down from that 6, 7, 8, 9% and is a more manageable 3 or 4%. So you don't have those costs as high, and so that's I think just given a signal for broader investors to come in. People like to talk about mergers and acquisitions. We haven't seen a ton of that in the gold space. There's been some smaller things going on, but I think what's happening is that going back to those technical indicators of gold, now being firmly in a gold bull market, excuse me. I think investors just expect that the gold stocks come next, and that's what we're seeing. So you do have the GDX and GDXJ that are bullish now, and I think buying begets buying. It doesn't have to be necessarily more complex than that.
Right. And I think it would probably be helpful to hear how you're approaching the gold stocks right now. And you can talk about that from a broad perspective, or if there are specific companies you want to mention, that would also be great.
Yeah, so I should always just lead with telling you that I do two things, right? I manage long-term safe capital in retirement accounts, and then I speculate as well, either in the open market or via private placements. So, on the quote unquote safer side, we still have a good chunk of capital in gold itself, a gold trust or a gold-backed position that we use as the anchor of our gold investments. And then on top of that, we have GDXJ. So gosh, in amounts of capital, but the two of those things are probably between 10 and 14% of capital, just those two positions. So that serves as the bedrock of our gold position. Then we take shots at, producing companies in that letter that are producing and generating cash flow, for example. On the more speculative side, what we've done is what I told you we were going to do back in October is we were buying companies that were developing assets that were cashed up that didn't have to raise money. Artemis Gold has been one of those companies. It's continued to do well, going from $5 or $6 a couple of months ago to $8 today. And just looking at those companies that have liquidity and that don't need to raise cash. I'll preach the same thing I was saying then is despite gold stocks having turned bullish and starting to outperform gold in the past 1 to 3 months, they've still been debased for a long time, and they would still have a lot further upside to go. I should mention that silver has not reached all-time highs, and there's fertile hunting grounds there as well. But you still have time, and you have the ability to be selective. Again, choosing companies that have already done feasibility studies, that have already proven themselves, and that have good management teams. So that's where I continue to hunt, and then even further down the value chain, in the explorers, it's sort of the same story. Those companies that have catalysts in the next 3 to 6 months and that don't need to raise money to make those catalysts come to fruition. So sort of my criteria doesn't change, just the when we're doing it based on what's going on in macro markets does. So I try to be consistent in that way.
Okay, great overview there. And just because you mentioned silver briefly, people are waiting for gold stocks to make moves, and silver is another one that people are definitely waiting for. So do you have any brief thoughts on what's going on with silver and when we may see silver start to move and catch up with gold? I guess it already is a little.
Yeah, I haven't been anti-silver, but I've been saying for a couple of years that it wasn't going to the moon like a certain cadre of the market had been saying for a long time. And that was the case. And reasons were grasped at as to why silver had to go up, monetary debasement, the end of the dollar, the things we hear again and again. And more recently, people were saying it was going to be because of solar or renewable energy. We need a lot of silver for solar. Well, this is an interesting point of distinction and a point of education for your listeners is that hasn't come to fruition. Like silver is going up now, not for any of those reasons, right? Even if you look at clean tech, like solar has been one of the best shorts in the market. Like clean tech stocks have not been working. So that's not the reason that solar is going up, or excuse me, that silver is going up. What's happened is that silver is being treated now as more of a precious metal than an industrial metal. Before it was trading sideways to down with copper. And now that gold has called a bid, silver is doing what it's typically done in the past, is it's being treated more as a precious metal. So for the same reasons people are buying gold is why people are buying silver. And so what I would say is that now silver is bullish where it had not been for a while. It's bullish for the same reasons that gold is bullish. And it will at some point in this bull market, outperform gold like it's done in the past. So it's time to start positioning in silver. It's still, below $30, where its record price is closer to $50, right? And here you already have gold at record high prices. So silver's got some ground to make up. I don't think we need to cover individual ways to play it. I think about it the same way as I think about gold. So there's trusts and there's, producer ETFs, for example. What I will say is that on the more speculative side, just me personally, and so this is an anecdote, so maybe take it with a grain of salt, but I've been invested in some private silver companies that have delayed going public for some time because the market hasn't been conducive to new silver stories, because silver hasn't been bullish. I would expect you see some new silver stories come to market because you have a friendly window to issue new shares or to tell new silver stories to the market.
Okay, a lot of interesting points there on silver. And I have one, I think, follow-up question, maybe on the psychological angle there. I was talking recently to somebody who got into silver during that silver squeeze time. And of course, then it kind of went sideways for 3 years. And now they're looking at it thinking, well, is it time to get out? Finally, I'm a little bit in the green. Maybe I should be done with silver. And of course, I don't like to give advice. For me, my reaction was like, no, not yet, not yet. So maybe there's something in there about not selling too soon in this environment.
For sure. I mean, that's, typical bag holder mentality. It sounds like, is they bought the rip while it was ripping, and then it's taken 3 years to get back to even, and now they want out. Yeah, a pretty good contrarian indicator. I would advise similarly to you. And I've told my, readers, and I've told myself the same thing for some of those stocks that I've owned a long time is, no, you've got to give them time to run. I guess I would parse the question in half, maybe. It's time to be reflective and put in that work on your portfolio. Going back to what I was saying about being selective, maybe if you can't identify a catalyst or a reason to continue owning it, maybe this recent bump is giving you the volume and the price you need to get out at break even, or slightly positive. But if it's one that you can identify as having future catalyst and being well run and being able to raise capital, that no, I would say, yeah, continue to hold it.
Okay, good to go into that. And of course, so another metal that we talk about most of the times that we speak, and we spoke about it last time, is copper. And you had told us the long-term fundamentals for copper were looking strong, but it wasn't quite working yet. And now in 2024, copper is another metal that's on the move. So I wondered if we could go into that and take a look at what's going on. Was there a catalyst there that's driving it, or is it more recognition of those long-term fundamentals?
It's both. So there's been a looming structural deficit in copper for a long time that lots of people knew about. The Wall Street Journal and Bloomberg would every couple of quarters run headlines about how the world was facing a copper deficit and how much we needed for, again, green energy, right, for electrification, for electric vehicles, et cetera. And yet the price remains subdued below $4 for most of the past 2 years, despite all those catalysts and fundamentals that everyone knew about. That last interview, the title of it that we did was I'm deploying cash into gold and copper, and I was telling you that I would do that in copper after the recession. So it's similar to the gold answer. What's changed is that the recession didn't materialize, not just in the U.S. It didn't materialize, but other countries have started to come out of recession. So I was telling you I was going to buy it when rates started to go down, likely in the second half of 24. That's changed. So you and I haven't spoken in 5 months. We started buying copper in February with my monthly issue on the back of China. So China was my main reasoning. China struggled to come out of its COVID recession, was in lockdown for longer, has had well-known economic issues with real estate and Evergrande, et cetera. But what happened heading out of 2023 to 24 is that the economic data in China, as well as the stock market, started to improve. And you saw similar things start to happen in Europe, specifically the big economies in Europe, like Germany, started to have like PMI prints that were expansive, above 50 for the manufacturing and services industries. So copper responds to that, right? It's an industrial metal. It's a doctor of the global economy. And so when China and Europe started to tick back up, that's when copper started to tick back up as well. So if I have to point to a moment in time and in a specific catalyst, it was back in January and early February, as the rest of the world started to come out of the recessions that they were in, and as it became clear that the U.S. was not going to go into a recession. And it's interesting. Sorry, one last thing on copper is, last year was the electrification that we needed all the copper, and it didn't go above $4, and now it's above $4, and now we need it for artificial intelligence. So you can see how the narratives change based on the price, but really it's the macro fundamentals and the super cycles that are ultimately driving the price. and then the humans adapt the narrative around it.
Yes, yeah. Oh, yeah, it's very funny. I think artificial intelligence is just working its way into everything, and copper certainly no exception. So I think, as with gold, I think maybe it would be good to go into how you're approaching the copper sector, how you're getting exposure.
Yeah. So it's almost a mirror, right? Sort of the same way. I don't necessarily hold physical copper in the way I hold a physical gold ETF, but I do approach investing in the miners the same way. So when we bought it in, our retirement accounts, we did so with an ETF, and there's a couple of them out there. There's CopX and iCop, and then Sprott has a couple more on the junior side. I selected an ETF that had more exposure to China at the time because that was the reason I was getting into it. So we bought iCop. It has, all the ones you would expect, BHP and Antofagasta, and even Anglo American as a top 20 holding, which, in the past 2 weeks has got a $39 billion buyout offer on the table from BHP. So we had access and exposure to those companies who are now, going higher. Ivanhoe is in there. So we own all those big names via ETF. And then again, when we speculate, we do so based on share structure and management teams and catalysts. So just thinking about my speculative holdings, Aldebaran, for example, is a company that's done well, has a very large copper gold porphyry system in Argentina that they've been drilling out for years. Well financed with deep pocketed partners like South 32 and Route 1. And so no worry that they're going to be able to raise money, and then they have drills turning now. So, this is one that despite, it being known that they had a good asset, that they had a resource, has, I won't say languished, but remains subdued below 80 cents, just like copper remained below $4. But in the past couple of months, Aldebaran has gone from below 80 cents to around $1, just as copper has started to come up. So we speculate on different tiers of the copper market, just as we do in gold, and parse those out into different levels of risk and how we approach it.
Okay, so that covers, I think, what's going on in copper at a broad level. And I want to also touch on uranium, at least for a little bit right now, because we usually figure out what's going on there. So I've definitely seen less interest in uranium as gold is moving this year. But yeah, I thought we should check in and see, is it in a consolidation phase right now? Are things going on that we're not noticing? What do you make of the market there?
Yeah, gold and copper has been more exciting in 2024, and uranium has been doing what you say. It's been consolidating. So it had an exciting 2021 and then part of 2022, but it's been consolidating sideways, not just the uranium price, but the equities. For the past couple of months. This is what I'll say. It's a long game. When you and I checked in 5 months ago, I was saying it was the third or fourth inning of a ball game. Again, back to baseball parlance. But it remains bullish. So we say consolidating. Well, what does that mean? Well, it went higher fast. It went higher fast, right? You had uranium prices come from below $20 a pound in 2016, 2017 to $100 a pound in 2023. It was one of the best performing commodities, I would say, in the world last year. Market has to digest those gains, and that's what's been going on now. That's why the retail crowd is frustrated. But if you look at the chart and if you look at the technicals, the consolidation has been a consolidation of a bull market move, and it wants to consolidate and then move higher highs, as opposed to lower lows, for example. So uranium remains bullish, albeit in sideways consolidation mode. And I guess tying it back to what I write about it and how I invest in it, different strokes for different folks, and stocks are starting to do different things now. Like, I'll just give you an example. Energy Fuels was a selection of mine because of its U.S. focused uranium production and mill capacity. A couple of weeks ago, they went and spent $250 million, something like 240 million US, on a company called Base Resources that has a mineral sands deposit in Madagascar. So changing focus more to rare minerals and critical minerals as opposed to uranium, and changing focus and jurisdiction away from the U.S. into Madagascar. So we were fortunate enough to have been in Energy Fuels long enough that we still had a profit. I didn't like the way they did that deal. It changed focus. So we repositioned. We took our profits out of Energy Fuels and we deployed them into a similar company that has more North American uranium focus. And so, and that's just what I say about, you have to manage the bull market. We anticipated it for 10 years and now you're sort of inside it and working through it. And there's decisions to be made and you don't control, sort of the inputs of those decisions. Like, when I woke up that morning, I didn't know that Energy Fuels was going to spend $250,000 on a mineral sands play. You have to sort of take that information and assess it. And I'll put my sales hat on and tell you that, that's what we do at Digest Publishing in our research letters.
Yeah, it's interesting to hear about your process kind of on a daily basis. And I'll throw in one small question about uranium because I'm sure that people are wondering. So we're in this consolidation time where we think it will be moving higher eventually. What do you think brings that next leg upward?
Yeah, that's an interesting question that I sort of thought you were going to ask, and I don't have a great answer for it, except to tell you this. Commodities move in cycles, and then I'm a big believer in cycles. I give talks about commodity super cycles and what's driving them. And I think that it's going to be a cascading or a wave effect, right? We talked about how sort of investors were bored with uranium right now because they're more intrigued with gold and copper. Well, you're going to see that, copper will do its thing for a little bit in copper, and then, it'll spill over into silver and PGMs and then back into uranium. I think that with higher inflation for longer and then with relatively stagnant growth, it's a good environment for commodities across the board to move higher. And they're just going to do so in independent cycles. But unfortunately, my crystal ball isn't going to tell me what the next one is going to be to send uranium higher. But I can tell you that it remains in a bull market and it will be something.
Yeah, and I appreciate sometimes, you just can't really know at the moment. So we'll keep an eye on uranium for sure. Okay, so we made it through a lot of different topics. And before I let you go, I'll put it back to you and ask if you had any final thoughts you would leave investors with, or if you want to let everybody know where to find you.
Yeah, sure. I appreciate that. We did mention silver for a little bit, so I would underscore that as one that's a next to move. And then I made a couple of notes, and then PGMs and nickel were also on there because you haven't seen a lot of talk about platinum and palladium. They're due for a run similar to gold, and they are used in sort of the decarbonization space. And I think more so than people realize. Like the last truck I bought in 2021 was a diesel truck. We're looking to replace my wife's Yukon. That will likely be a diesel, and they're in those catalytic converters that make those cars burn cleaner. And so they also, some of those deposits are PGM plus nickel, right? You hear a lot about PGM plus gold deposits, PGM plus nickel deposits. And nickel remains sort of in that electrification space. We're working through some Indonesian oversupply. And we saw that Russian component out there too with the sanctions and things. And they're good producers of PGMs and nickel. So just ones to keep an eye on for the future, I would say.
Okay, very good. I think that sounds like a good place to wrap it up. So thank you so much for coming on once again to go over all of these topics.
Thanks, Charlotte. Appreciate it.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is Nick Hodge with Daily Profit Cycle. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.